All right, guys, this is a continuation of the beginner to intermediate courses for options. We're going to be doing this one on the long butterfly. If you watched last week, it was on the long call butterfly. We're going to be doing it on the long put butterfly this week. Let me get a couple of things out of the way real quick. My name is Eric Wilkinson. Some of you guys may recognize me from CNBC, Fox Business, or even the Wall Street Journal for my commentary on everything from economic to geopolitical and market analysis. I actually started out trading in college with some money I had earned working throughout high school, put it in a bank account, and kind of there was a nice chunk of change, and started trading, buying stocks, and then trading options against it by the time I was graduating. In that time, I started out actually with a psychology degree, and to this day, I still think that the psychology degree is probably more important than my financial degree, because I'm not really going and digging into the books of all these companies. But having said that, moving up to Chicago, sold all my stocks, bought my badge, and jumped into the pit and started trading. So I've been trading my own money, I should say, for well over 25 years, and I've traded everything from stocks, financial futures, commodities, and options on all these products, even the currencies there. So I've been trading for quite some time, and I've pretty much seen just about every type of scenario. I started out in the pits, moved to the screen, and now was trading on the screen in the pits, but now trading at home all day long, which is kind of nice. Oh, Farshid, yes, this video should be sent. If not, reach out to us at trading@protraderstrategies.com. Usually it takes me a while. I do record this, but then it takes about an hour or so to convert it so that everybody can watch it, and then we send it out. So it kind of all depends on all that. Oh, you need last week's. Yeah, reach out to us at trading@protraderstrategies.com and let them know, because something might happen. I think I did end up waiting last time because I had to bolt out of here right away for soccer, and I think I didn't get it in the system until like midnight when I finally got home. All right, anyway, a little disclaimer here. Any opinions, news, research, and analysis or other information contained here is provided as general commentary and does not constitute investment advice. Basically what this all says, you guys, and this is something I am a champion of. I do not believe in just giving trades out like, hey, this is a great trade, you guys all need to jump on board with this, and like do the pump and dump thing. I don't do that. The reason why is because I don't know your risk parameters. I don't know even what's in your portfolios. So if I'm like getting short Tesla and you're bullish Tesla, well, that doesn't really fit your book. So what I'm trying to say here is that I'm going to be teaching you guys different strategies throughout this whole course, and it's up to you guys to really learn it and implement it in your portfolios in your own way, with your own stocks in your own directional assumption, if you will. Bottom line is, do your own homework, and please remember that past performance of any trading system or methodology is not necessarily indicative of future results. You're lucky most young people graduate from college with a degree in unemployment. Rick, that is very true. And but I'm lucky. Okay, so I have a little thing. I don't believe in luck. I think you create your own luck in a sense. And having said that, I was working on a farm ever since I was like 11 years old. Now, I was lucky in that regard, I guess, in a sense, because I had a family that had a business that allowed me to work before I was really supposed to be able to work. But I was working in the field since I was 11 o'clock since I was 11 years old. And my parents would dump me off at my grandparents' farm, and basically that was where my summer vacation was. It wasn't going to a camp or anything. It was going to camp Breakback Farm is what it seemed like. All right, so you guys can follow me on Twitter at Wolfman's blog, or follow me at ProTraderStrat as well. So any one of those, you'll get more snark out of me and more wisdom out of ProTraderStrat. Hopefully you'll get a little wisdom out of me, but you're going to have to filter through some of the other stuff too. All right, so I mentioned this is the long put butterfly. Last week we did the long call butterfly, and if you guys didn't see that one, you can reach out to us and get that strategy sent to you. These two strategies, the long call butterfly and the long put butterfly, are very similar. The market assumption is sideways to neutral. Anyway, we want this market to move sideways. We don't want it to go too far away from where it's currently trading. If it does, we're just going to kind of leave this on and wait for it to come back into line. And I'm going to give you guys some little things that I look for when setting up this trade. But anybody know how to determine if we're going to use the long put butterfly or the long call butterfly? Because really they're the same thing when we're dealing with a market movement that is inside the wings. Now, if the calls and the puts, we're going to be basically picking the same strikes, and we would have the same desired result, that the market stays where we are. But how do we determine if we should be using a call butterfly or a put butterfly? Does anybody know? Long call butterflies for neutral to bullish. And okay, John, that's a great long call for neutral to slightly bullish, and put call for neutral to slightly bearish. I agree with that. That's a good one. Depending on whether or not you want to add deltas or subtract deltas, JQ, that's a great one. What I'm looking for, though, you guys are blowing me up right now, and a lot of great answers, and they're all pretty dead on. What I'm looking for here, though, is skew. And if you guys, I know a lot of you guys are returning, and some of you guys watched some of the earlier ones, which is really important because I'm trying to build on all of these strategies as we go, and talking about giving you guys little nuggets here and there that we're going to continue to use on down the road. Now, skew means whether or not the market is pricing in bearishness for that particular stock. So what happens is people are more bearish in this underlying. They're going to buy puts, and that's going to pump up those. And sometimes the equal distance call from where the underlying is to the put. So let's just give an example of 100, a stock trading 100. The 95 puts, if the stock is trading 100, we're going to be looking at those 100 at the money puts. But if we look at the strike being 100 and we look at the 95 puts, if the 105 calls are trading exactly the same price when that underlying is trading 100, then there is a very neutral bell curve that we normally look at. If the puts are priced higher by maybe a nickel or so, that means there is skew to the puts. Therefore, we would want to do the long put butterfly if the skew is to the puts. Now, if the calls, if the underlying is trading 100, and we look at the 100 calls and we go equal distance away from the at the money, we go to the 95 puts again. And if those 95 puts are, let's say, trading, $1, and then the 105 calls are trading $1.05, that means they're skewed to the call side. Does that make sense? See where I'm saying? So then we would want to do the long call butterfly. You have to look into these options premiums and kind of discern whether or not the long put butterfly is better for this situation or the long call, depending on the skew, because we want that premium pumped up for these, because those at the monies are the ones we're going to sell, and that's where we're going to be getting a lot of money for. So we want those premiums pumped up. So pretty important, not super important, but it will help you out here and there, and sometimes it will there will be a drastic difference. So make sure we determine where the skew is, and when I pull up the platform, we're going to go through this. So don't get too wrapped up in this right now. I'll show you how to figure out skew, but that is the determining factor, the skew. If the skew is to the puts, we're doing the long put butterfly. If the skew is to the calls, we're going to do the long call butterfly. And you guys are already blowing me up. I'm going to probably have to grab my glasses to read all these. All right, so outstanding in your field. Oh yeah, I was outstanding in the field. I was a little guy, but you know what? It was nice because all the teenagers were detasseling, and I was getting to drive the tractor when I was 13 years old. You know what? You do know that there were child labor laws back then, Wolf. Trevor, there are still child labor laws, you're right, but if you are actually working for a family business, they can't do anything about it. For the put, you have a slightly bearish bearing. At SB, we are going to talk about that, and it has to do with the deltas. I'll show you how to set up even a put butterfly where you would have long deltas and stuff like that. So long call butterfly for neutral to bullish, and I think I've already read that one, and put for the bearish to neutral. You could set it up if you wanted to add deltas. What IV rank do you want in, or high? Want it high for a long put butterfly? Yes, and I'm going to talk about that a little bit more in detail here in a second. Do you want a price action to move past the short, I don't know what that word is, to the long out of the money call? You actually want the, you do not really want it to go outside of it. And one of the things I'm going to look at, we're going to ride this out because it's a really low probability strategy. So we're going to have to ride this out a little bit longer. And I'm going to, when I put this strategy on, we're going to be paying a debit for it. And I'd say probably about 90% of the time when I have a debit spread on, if it goes against me, I just kind of look at it as that was the price of admission. I know what my risk is. I'm just going to leave on anything for the most part that when I pay a debit. If it goes against me, and just let it expire worthless if it has to, but it might come back. So I'm just going to hold on to it. How do you check the skew on your platform? I'll show you. I just do it in my head for the most part. It's not really, I don't think that there's an actual scan or anything for that. This may be basic, but aren't puts always more expensive than calls? They are not always. They are generally, I don't know what the percentage of it would necessarily be, Neil, but if there is skew, if people are really bullish, say for Apple, a lot of times has skewed to the calls because people are very bullish in Apple. I'm going to butcher your name, but I want to say hello back. It's Charvezwar. Good to see you. When you said move in the wings, you don't want the price to go too much out of the money. Well, we'll talk about all that stuff here in a second. Hold on a second, because we're talking calls there for a second. Let me show you the setup. Right now, we're going to be looking at a market neutral movement. We don't really want it to move outside the wings. And these are the wings, the long in the money put and the long out of the money put. Basically, a long put butterfly is just a short put spread added in with a long put spread. And when you squish those two together, that's what you come up with for the butterfly. And the reason why we called it a butterfly back in the day on the floor was basically because you're selling, two at the money. So you got two at the same strike, and then you got one higher and then one lower to define that risk, right? Well, what happens is it kind of looks like a butterfly like that with a really happy butterfly. All right, so that's kind of like how we came up with that. And there's all kinds of other strategies that's very similar to, you added a couple of different strikes in there, and it'll build out a different strategy, like the Christmas tree and things of that nature, condor or whatever. All right, so keys to success here is picking the right environment. Now, we started out knowing, okay, we're looking at a sideways market in a particular underlying, okay? We're looking at XYZ. We have a sideways market in this. We need to know whether or not we're picking the right environment. We need to have high implied volatility. Now, this is going to start getting tricky with any type of judgment on volatility going forward, because we're starting to see higher implied volatility. If it goes back to what we've seen for the past 3 or 4 years, which is somewhere below 15 in the VIX, let's say, then I'm going to show you a couple of things to determine whether or not it's the right environment, because we're going to have to do a little bit of math. It's not going to be as easy as it once was because we have some spikes going on. But basically, the higher the volatility, the less we are actually going to have to pay for this strategy, because those at-the-money puts are going to be pumped up with premium, and that's where our collection is coming in. So it will pay for some of those wings, our defined risk. So the higher the volatility in that particular underlying, it doesn't necessarily have to do with the VIX spiking to 50, but it will help, obviously. But the higher volatility for that particular underlying, and that has to do with implied volatility for that underlying, the higher that is, the less we end up paying for that strategy. And I'll show you all that stuff here in a little bit when we pull up the platform. I just want to get out these rules. You know, you guys should go through these, and this is like a checklist when you're going through and making sure you're covering all your bases here. Picking the right underlying. So, you know, we had an XYZ, we have a market neutral assumption. We have the right environment. Does it fit being the right underlying? What does that mean? Well, what that means is a tight bid ask. And when we're looking at bid ask, we'll go over here to the option montage. And usually I look at, you know, you could look at the 14 days, but I like to look at around the 35 days. But the closest monthly expiration, I would say, is probably the best one. And my rule of thumb here is a stock under, let me find a good one, a stock under $100. All right. Any stock under $100, we want this bid ask on the calls and or the puts that are really close to the at the money. Don't really go into the money because those get a little bit wider, but these ones that are pretty close to at the money should be inside of 10 cents for any stock under $100. Now we start getting over $100, then what we're going to look at is moving the decimal place 3 ticks to the left. So 19 cents for, let's say, Costco. It's trading around 25. So it's right around 19 here. Those are pretty far away. And but that is the rule of thumb. Move it 3 ticks to the left, you know, 18 cents. You could even call it 20 cents, something like that. And, you know, $1,000 stock like Priceline, or it's now called Booking.com. If you guys were following me on Twitter, you saw my panic on Twitter trying to do a Priceline trade and not realizing they switched their ticker to Booking.com. But anyway, what we would do here is, again, move the decimal 3 ticks to the left, and we got $2 wide. So usually, you know, Priceline and Booking will have that pretty tight market inside of $2. So that's kind of a rule of thumb to guide. You know, if you go in there and you're trading a stock that's like, you know, what was the one I was looking at earlier, the Amgen. So Amgen, you know, I usually only trade Amgen for earnings. They do get tight markets for earnings, believe it or not. But look at Amgen. I mean, a lot of people have heard about this company. You move it 3 ticks to the left, 18 cents, 19 cents. We could even call it 20 cents. It's $3.20 at $4.75. That is huge. Think about the edge you have to give up to get into this trade and the edge you have to give up to get out of this trade. Now, if you're a really savvy trader and you've been in the markets for years and years, you know, this rule of thumb might be able to be bent a little bit, but this is ridiculous markets. I mean, I wouldn't get involved in this because if volatility expands or anything happens, it's going to be very difficult to get out. You can see once it goes into the money, if I was wrong on a short call or a short something like that, it goes into the money. Look how wide those are now, $4.35 wide. Can you imagine trying to get out of that? You'd be in that trade for days. And if you have to give up, you know, that much edge to get in, I might have to sell it, offer $4, and I wait 2-3 weeks, the market goes in my direction, I might be still staring down the barrel at only being able to get out of $4 because I have to give up so much edge to get out. That doesn't make sense, you guys, because you took all of that risk for a scratch. So unless you really have been trading for a long time and you really understand options and have a very high risk tolerance, I would stay away from this stuff. If you're a newer trader, I would definitely try and stick to that rule of thumb. You will thank me one day because those pennies here and there will add up. We could look at something like, you know, a comparable would be Apple trading right around that same price. And we're going to be looking at Apple being, you know, 6 cents wide. Much better prospect of being able to get out of these options, right? If we needed to. And you go out even further and it's still inside that rule of 10 cents wide. So that's my rule of thumb for picking the right underlying. Don't get involved in something like Amgen, especially if you're doing the long put butterfly. The more legs you do, think about that. You're going to have to give up more and more edge. You're going to give up more edge on both sides, which, will really end up hurting you. So the more, if you were just doing a long call or a short call or a long put or a short put in the Amgen or something like that, you're still got to give up a lot of edge to get in and out. But just think, if you have multiple legs, all those different legs you're giving up edges on, and it will end up eating up your yield. So a 10-cent spread will be $20 per round trip per option. Is this correct? 10 cent spread. I'm not really sure I understand what you're saying, Char. So a 10-cent spread will be $20 per round trip per option. Bid to the ask. Well, if you're doing a one lot, yes, yes, it will be, but you're not going to have to give up that edge. You're not selling the bid. You're not buying the offer every single time. So I guess maybe that's the confusion. So, a lot of times if you are trading toss and you're doing single options, they are going to default you to sell the bid. If I go in here and hit that, it's going to default me to the bid. The one thing I want to express to you guys is never do that. You can see the offer is at 435. I would probably start out, well, it's not giving me the option. You're going to have to go mid-price, but I would probably start out just inside of this and ratchet it down. I never start out at the mid-price, and I will never sell the bid unless I really have to, unless I'm like, I've decided to get out like right now. I'm probably not going to sell the bid. I'm going to offer it a little bit higher, put it in, confirm, send, let it sit. By the time I go back here, I want to put it at a price where I don't think I'm going to go get filled. By the time I go back here and change it to cancel replace, that's enough time to let it meld in the market as far as I'm concerned, if you really want to put on the trade. And then just keep ratcheting that down until you get to about mid-market. I wouldn't always go to hit that bid unless you really needed to. All right. So picking the right duration with this particular strategy, we want less than 35 days to expiration. 45 days, if you did this on Monday, I'm not going to really bark too loud about it. But I like to have this theta decay happening, because remember, we're selling those at the money calls twice. So those are going to decay, and that's what we want. That's where we're going to be making our money, is where those are decaying. Those are the premiums we want to decay rather quickly. So I want to be in here. Plus, it is a low probability strategy, and it's going to take a long time to, get that full max profit. I'm not going to write it for the full max profit. You're going to have to take it into the last day to get that, and you still probably aren't, because you're selling the at the monies. But it's just not normally going to be achievable. You'll probably have to pay up a little bit. But per my other rules, I'm not going to go for that full boat. I'm going to try and pay very little for it, get that expansion, and get out of this trade, because it's a low probability strategy. If I can get my target, then that's what I'm looking for. If you're way out here, you're going to be able to get a little bit wider, I will admit, but it's just such a low probability strategy. By the time you get down here, what's the likelihood 100 days later that the underlying is trading exactly where it was 100 days ago? It's just not going to happen very often. But the next 10 or 15 days, yeah, there's a pretty good possibility it'll stay there. So that's what I'm looking for, being inside of this theta decay ramp where it starts picking up, and get out of the strategy rather early. Could we use this on weekly options? Absolutely. You can definitely use this on weekly options. But if you do, go look in those weekly options. Make sure that it is still following that rule of thumb we talked about on picking the right underlying, 10-cent bid ask, or move the decimal place 3 ticks to the left on stocks over $100. Does that make sense? Wait a second. Sorry. Talking about low probability strategies, how would it work in current market conditions, pros and cons? Well, the pros are in volatility environments. We're in a high volatility environment right now. Usually volatility is overstated, okay? Most often volatility is overstated because it's a fear indicator. And, you know, what happens when there's fear? We usually overreact, right? I mean, if you're afraid of spiders, what's a spider really going to do? But people are terrified of spiders, right? But that emotion is a little bit overdone. That volatility that person's going through is probably overdone. Once they smash it or somebody else smashes the spider, or they do it themselves, you know, all that volatility comes out and you realize, why was I so scared of that little spider or whatever it is, or a mouse that's trying to get away from me, or, you know, those kind of things. But fear is generally overstated. And that's kind of what we want with this strategy, is to have that fear overstated. Volatility comes out, and when volatility comes out, it's going to allow us to get out of this strategy quickly. All right, picking the right strikes. Well, you're doing a butterfly. A lot of people set this strategy up for very directional moves, trying to, you know, nail the number, if you will, where, you know, I think, let's just say Apple is going to be at 180 in the next, you know, 40 some odd days, or maybe up here at 180, looking at a Fibonacci extension or whatever, and pick maybe, let's just say you're bearish Apple and you're going to do this down here where you're going to hit these strikes. I don't play it that way. If I have a directional assumption to the downside, I'm going to pick a more directional strategy. This to me is market neutral. So, you know, there's strategies for other moves that are going to be higher probability. This is when I've got this feeling, hey, you know, this underlying is made a big move, or it's going to settle down, those kind of thought processes. I don't know what normally triggers you guys into a neutral thought process or a neutral market assumption. I know what mine are, and I'll go over some of those on some of the stocks I've vetted already for this strategy. But all of those things, I don't like it to try and pick a directional move. I think that there's better strategies for that type of situation for sure, and definitely higher probability. So picking the right strikes, what I want to say with picking the right strikes here is, what at worst case scenario, when we're building this strategy, we're going to be looking at making one, risking one to make one. And what that means is, you know, on a $5 wide, I pay $2.50. Okay, that would be risking one to make one, because I'm paying $2.50 for a $5 wide. I'm risking $2.50 to make $5 or $2.50, right? So that's risking one to make one. I like to get this. I don't like to pay a lot for this strategy because it's such a low probability strategy. You know, if I'm risking one to make one, you are basically 50% probability. You know, if I paid $5 on the spread and it's a $5 wide spread, I got 100% probability of success, right? And you will see situations where, you know, you might be paying $4. I'm making a joke there, but you might see situations where on a $5 wide, you're paying $4. Does that, yeah, you have a high probability of success, an 80% probability of success, because if we take $4, divide it by 5, you're going to see you had an 80% probability of success. But you're risking $4 to make $1. I can tell you there are better better strategies to do than paying that wide for the spread. It's just paying way too much. So picking the right strikes, no more than risking one to make one. I like to kind of do it where I like to risk one to make 3. That kind of makes up for that. You know, it's a very low probability strategy, but if I can make 3 off of that one I risk, then I'm more willing to do that. So for example, like a $5 wide, paying less than $1.50 is a great situation that I like to get into, or $2.50 wide, pay less than 80 cents for that. If you increase the width of these wings, you are going to increase your probability of success, and but you're paying a lot more for it. You see what I'm saying? So, you know, your tighter wings decreases your probability of success, but, you know, your risk reward is much higher. And I'd rather play this low probability strategy with a high reward to my risk. All right, so what is that? Knowing our exit strategy before entering the trade. One thing I mentioned, and a lot of other ones that I kind of forgot to mention here, is on these keys to success here. I said kind of go through this checklist here. When you're doing that, write all that stuff down. Get yourself a spiral notebook and write down every single trade you do, like the date, the trade, why you got in it, and what you paid for it and what your exit strategy is. And almost most importantly, write down where you are planning to get out, because you get to that point, and if you don't have it written down, you are more likely to go, you know what? Maybe I was wrong on this exit strategy. I'm going to squeeze it out a little bit more. That's what we used to call it on the floor, when you try and squeeze a couple more pennies out of that. It's like you almost trying to wring the towel out to dry it. But write it down, because you get to that point, and if it's written down, you're going to be like, all right, I wrote it down, I'm getting out. So write down all of your trades, you guys. It will keep you more mechanical, and I would almost assure you more profitable, because those times where we were talking about this right before the webinar started, those times you look back and you're like, okay, well, I got out where I wanted to get out, but it kept going. I could have made more money. Don't ever look at it. Hindsight's 20/20. You guys, it gets to that point. You said you were going to get out. You had a reason. You wrote it down. All of those things are still in your head. Get out, because it might go through it for like maybe $1 or something like that. And you're going to be like, I could have made another $1. And then the next day, whoosh, it just free falls. And you're like, wow. Especially that'll happen more often when you are staying in that trade. And so bottom line is, the times you guys squeeze it out for a couple other pennies is going to be profitable, but the times you squeeze it out and it turns around on you is probably going to more than likely eat up those profits and then some. All right, so write it down. So, my max profit or exit strategy is, because it's a lower probability strategy, I'm going to try and get out when I've received 2 times that debit paid. All right. So that's especially when I'm paying very little for it. All right. 2 times that debit paid. Or if I'm right there at the 50-50, on that one where I paid $2.50 on a $5 wide, I'm going to look for a 25% of max profit. All right. So that would be like 65-cent increase. So $5 wide, I paid $2.50. When it increases by 65 cents, or I can get out at $3.15, that's where I'm getting out. Does that make sense? On a 50-50 shot, I'm going to only go for a 25% increase in the premium value. Or if I pay very little for it, say I pay $1 for a $5 wide, I'm probably going to be getting out at $2 when I can get out for $2. So the less you pay, I'm looking at, if you're paying a fifth or a quarter of the width of those strikes, being, $5 wide, $1, or let's say $1.50, something like that, 2 times that debit paid is where I'm looking to get out. If I paid $2.50, 50-50 chance, I'm going to be taking a little bit less there. That makes sense? All right. Max loss, premium paid. Anytime you are doing a debit spread, premium paid is your max loss. So if I'm paying very little, $5 wide, I'm risking $1. If this goes against me, goes outside my wings, I'm just going to let it ride, you guys. I'm going to let it ride into the sunset, because stranger things have happened. Markets, especially in those last couple of days, it could come right back down to where we are, and I'm just going to ride it out. Max profit, though, is the in the money put minus the at the money put minus the premium paid. Now, we talked about this. If it's $5 wide, basically what this is saying is the wings are $5 from that at the money, right? At the money, the in the money. That's the wing to the wing, from the base to the wing, from the base to the wing width. $5, we talked about that. We paid $2.50. We said in that example, our max profit would then be $2.50. $5 wide minus $2.50 is $2.50. All right, so break evens. Now we have two break evens because we have two wings. You know, the market can go up, the market can go down. We want it to stay neutral, but we need to know where our break evens are for the market move. And all of these things are at expiration, okay? None of this, and their max profit may not be exactly $2.50 because people aren't going to do anything for free. They're going to expect a couple of pennies edge. So you know, just to keep in mind, this is in theory. It doesn't really always work out that way. Break even though at the money put plus the premium paid, or the in the money put minus the premium paid is going to be our break evens. Now I see you guys got a bunch of questions popping up. I'll try and read those while we get set up for the next section of the webinar here, which is going to be where I tell you guys throw out some ideas. We're going to look at a couple of your guys' stocks and see if it goes through that list of rules of thumb that I have, and see if we can find a strategy, or see if we can put butterfly in there, the long put butterfly. So throw in those in the questions box and we'll get to it. So do you consider today's market neutral or what? Chuck, I don't consider the over. I wouldn't do this on the S&Ps or the Dows right now, but there are definitely stocks that I've found that I've even vetted that I think that are going to be good candidates. So you are saying we should at least, well, at most, you should, John, you should at most pay one to risk one, or risk one to make one. All right, that's at most. If you are risking $1 to make $4, then that's a much better situation. Your wings are going to be a little bit tighter. Your probabilities of success are going to be a little bit lower. But with this strategy being, you know, very difficult to not pay a lot for, you know, I don't like to pay a lot for anything. So this is going to be one of those situations where I think this has made some big moves. I think it's ready to settle down. And I'm going to go with it that way. Can you please clarify the break even? Yeah, so let's look at it on here. I'll look at Microsoft real quick, and we'll look at the break evens on the Analyze tab because, you know, saying it may not be as easy to understand as the visual. So Microsoft is the first person I saw throw something up. All right, Microsoft, let's delete whatever that is. Microsoft, I'm going to go with the 49 days to expiration. I wouldn't normally do it this far out. I don't think there's enough time necessarily in the 14 days, but we can look at both of them. We'll just check it out. So the underlying is trading at $93.05, so it's under $100. We want the bid ask to be inside of 10 cents. It is. It is not right now. It's really wide out here. That has to do with on a Friday, after the close, everybody cancels all of their orders and they get pretty wide. But Microsoft, generally speaking, is inside of that rule of thumb. So I'm gonna make that call to say it's okay. We're trading $93, right? So the at the monies, in a sense, are probably closer to the 92.5s. We can look at a chart and all of those things. But what I want to specify here is if we look at the 92.5 puts, this is what I was talking about, skew. Let's see if there is skew. That's pretty close. It's about 50 cents higher than this. So it's going to be a little bit off. But we can look at the 90 puts are trading around $1.80. Let's just go mid-market, $1.81. And then these calls are trading $2 and what? 15 or $2.20, let's call it. So $2.20, and these are trading $1.90. Now there is a little bit of movement to the upside, which is going to cause these to increase in value by probably about 25 cents, which still means there's a little bit of skew, 25 cents on my mid-market $1.80, right? So we're at 205. That's still a little bit of skew to these upside. And, you know, the way I got that increase in value from here is the delta is right around 50. So for a 50-cent move, these should increase by about 25 cents, ballparking it. Does that make sense? That's one of the things that Delta tells us, right? For the first dollar move, this premium is going to increase by 41 cents. Well, if I can kind of look at the premiums, well, this is higher by 50 cents. So these premiums in here probably have 25 cents extra. But that still means skew is to the upside. So this would be a situation where you would look at doing the long put or long call butterfly instead of the long put butterfly because they're skew to the upside. All right. Bullishness being felt in Microsoft. So I would do this as the long call butterfly. So let's look at a different example. Is this strategy appropriate for earnings season? SB, I do not use this for earnings season because you got to really nail the number. I don't often use this strategy. It's probably one of my least favorite strategies. I do still use it when I have an assumption, and I've got a couple of them that I've found, but I don't use it really often. But when I do, it's because I'm feeling like it's ready to settle down, and it's the best strategy for that neutral market assumption because you get the best bang for your buck in a way. I think I answered all the questions so far. Have you ever done this for a credit? No, the only way to do this for a credit really is to do the short put butterfly. You can't really do this for a credit unless you start breaking the wings, and I'm going to be doing a webinar on that down the road a little bit. All right. If you sold 2 puts or calls at the stock price, aren't you risking being assigned on the stock before you can close out the position? You are, Doug, but when you're out there 30, that's one of the reasons why I don't like taking it in, and I'm kind of sketchy about this whole going in 14 days to expiration. One of the benefits is that, remember that chart I showed you earlier on theta contraction, you get inside of 14 days, you can see this is really picking up, and that's kind of what we want. You get inside that 7 days, you are really risking assignment, all right? A lot of times out here this far out, you got in the money puts or in the money calls, people aren't going to assign you on it. There is a risk of it, but they aren't likely to. But the closer you get down here, people are willing to take a little bit more of that risk on. So I don't like taking options inside of 7 days. I like to be inside of this area for that, for any trade. Unless it's a loser, like it's outside my wings, that's the only time I'm going to take it into this. And in that case, you do have the other options to offset somebody assigning you on it, right? Because you have a defined risk strategy. You can always assign somebody else. You can put it to them. But that kind of becomes a little bit more costly too, because you are paying a lot of those transfer fees, and anymore, I think we're starting to see less people do the, put it to them or assign you on those calls, those short calls or short puts, because people are looking at it like, well, the commissions on just getting out of that rather than just assign somebody on it and it's going out there and buying the stock. It costs you very little to go out and buy the stock for commissions and very little to get out of those options. A lot of people, I think, are seeing that light, getting out of the options rather than and buying the stock or shorting the stock rather than doing that whole assignment game because it's pretty expensive. Does that make sense? Yes, and there's no sense in assigning somebody if there's time value left, right, for sure. Neil, I'm going to have to read that in a minute because I'm a slow reader, and maybe copy and print that in a second one to make sure it doesn't run off. I'll try and get back to you on that. All right, so that's key to this, is we're trying to get that decay. Well, we're stuck between a rock and a hard place because I don't want to be in this too long for that assignment risk. And I don't necessarily want to be this far out, but let's check both of them. Let's see where we want to be. So the puts at the money, this is the closest to at the money. We need a little downward direction in there. Anytime you're building these out, yes, you can go up here and do butterfly. I don't like to do it because I like to play around with my strikes. And what I do is my rule of thumb on this one would be $5 wide on a $100 stock, right? So they're going to try and give me the 90s, and I'm going to have to keep playing around with it. But I'm going to go with the 2.5s, buy the 7.5s, and then they're not going to let me do that. Darn it. Let's go down here. Did you see why I can't do that? Because it's going to be unequal distance. If I do the 2.5s and go all the way out to the, oh yeah, no, that works, $5. I don't know. I guess I had a brain cramp there on math. Oops. So I want to sell 2 of the at the monies and then buy $5 down, buy those. Why is my thing freaking out here? Buying $5 lower, and all right, what's going on here, Eric? Start over. Selling 2 at the money, buying $5 because it's $100 wide or $100 strike, so we go to $5. It's my rule of thumb here, so the 7.5s do work. All right, so we have a $10 wide, right? Or sorry, it's a $5 wide, and we're paying $4.18. Does anybody want to do that? Got an 82% probability of success. You got to hope that in the next 49 days it doesn't move $5. So to me, I'd stay away from that one. You know, if I had a market neutral assumption on something like this and I had to pay that much to get a reward of 75 cents, I'd probably do like an iron condor, right? Because an iron condor, I'm going to be able to get like, you know, I could probably get that 70 cents easy and be outside of where the wings were. So I'd have much higher probability of success being inside of here on a market neutral strategy doing the iron condor than probably I would even with the butterfly. Okay. So if you're paying over 50%, you know, there's other strategies out there that are higher probability that you're probably going to be able to get that same premium by just collecting a credit on an iron condor or something. All right. So I would stay away from Microsoft on this one. Another one was, I think it was UPS. Let's look at UPS. So, and you know, one other thing I wanted to mention in that disclaimer and stuff like that, you guys, I may have stocks and options on some of these products that we're looking at. I'm not picking them to try and get you guys to do the same thing I'm doing. I'm doing it because that's what I feel. That's what I've seen in the market. That's where I'm leaning towards. So it only makes sense for me to talk about those, right? It doesn't make sense for me to talk about something that I completely don't believe, right? Like, you know, like being bullish on Tesla. You know, it's my personal thing. I can't be bullish on Tesla. So anyway, that's a different story altogether. So let's look at, what did I say? UPS. UPS, let's get rid of that. It's just confusing. I don't even know. So UPS is trading at 105.37. So 105 is probably the closest to the at the money. Let's look and see if they have skew. We'll just go $5 down to the 100 strike. It's trading around 160. Let's just call it, you know, for easy math, somewhere in there, 156 to 161. We go $5 higher. These are trading 170. So the calls are skewed. Now, when I was betting that, looking at this earlier today, it was actually skewed to the put side. But that late day rally that we got, that crazy turnaround, looked like a lot of people were probably scrambling to buy some calls for the weekend. All right, so but let's just look at it. Probably be a better idea to go to the calls on this, but let's just look at another example. So that's skewed to the call side. Let's look at who was it? Verizon is skewed to the put side. Or at least it was. So Verizon skewed to the put side. Let's just look at it. Where's the underlying trading? Real close to 48. So let's just look at going, because they get a little funky here, don't they? Because they start skipping strikes. So 40. Let's just go $2 either way. So we're trading right around 160. Go $2 up. actually $2 down just to make it clear. So we're looking at about 85 cents. We go from 48 to $2 down, about 85 cents, and then $2 up is these 50s. That is the skew to the downside, right? These $2 up, $2 away from that, the monies are 70 cents. These are 85 cents. So there's almost 10 cents skew to the puts. See, that's what I'm talking about, where the skew is. You kind of look at it, the underlying, this is a pretty good one because it's very close to it. Go $2 down there, they're skewed there. It is off by 26 cents to the upside, which would even say that it's skewed even more because these should be more valuable, right? Because it's 26 cents closer. But the skew is really to the downside here. So let's look at a butterfly here. So that we're going to say these are the at the monies. One thing we got to make sure, right? It is tight bid ask, right? Fits that rule. It's an IV percent of above 50, which is my rule of thumb for this high IV. Anything above, the higher the better, but it needs to be above an IV of 50. One thing we were going to need to note with these spike that we saw back here, this spike is higher than we've seen in the last year or so. Yeah, coming into this earnings, there was a lot of implied volatility, but this spike may very well be an anomaly. If we started seeing this come back down here and trading down here for a while, let's say 3 months down the road, we gotta really broach this subject. This might be at a normal, pretty high implied volatility, close to 100% if you take out these last spikes that we've gotten just in 2018. This kind of situation here might not happen for another 2 or 3 years. So we're going to have to deal with this for the next year. So the way to figure out implied volatility percent, if this starts becoming an issue where you ever have a stock where you just see a spike that's out of the blue, implied volatility percent ratio or fraction is you have a numerator and a denominator. In the numerator, you got to find the sum of where the current implied volatility is minus the low and divide that by the sum of the high minus the low. So if you're going to need to discount this, like in a diving score, we just had the Olympics, the skaters, they drop the high score and the low score. Well, in this case, you don't usually get really low spikes. You only really get really high spikes. So you might need to discount that. So you would say that this would be the high in a sense, okay? So play around with that because it is going to become important if we don't see implied volatility remain elevated, okay? But right now it is above 50, so that fits that rule of thumb. We also discerned that the bid offer is tight on the monthlies. The skew is to the downside. So all those things being pretty good, $50 wide or $50 stock, my rule of thumb is $3. $100 stock, my rule of thumb is $5. So $200 stock is $10 and so on and so forth. So you can kind of ratchet that up, for a $1,000 stock, you're looking at $100 wide wings. Okay, so just keep ratcheting that up, right? $100 stock, we know $5, $200 stock, $10, and continue on that. That's just a rule of thumb. Play around with those, but that's your kind of starting point. I don't ever do a $1 wide one here, and I don't usually do it just a $2 wide, but it's only going to work out that way right now. So the 48s I'm selling because those are the closest at the money. $2 down, buying those, $2 up, buying the 50s. So we have a $2 wide spread paying, let's call it 50 cents, right? So that is a quarter the width of the spread. So that we're paying very little to make $1.50. And we can look at this on the Analyze tab. I don't know what happened there. I'm clearly going the wrong way. So let's look at this on the Analyze tab. So let's get rid of that one. Analyze tab. As you can see, I had that other one vetted. So we're risking 50 cents to make $1.50, risking 1 to make 3, right? So that is good. That's a really good scenario. Now, obviously, we've got to stay within the wings here and 1 standard deviation to 1 standard deviation, we have to nail this number. That's why I'm willing to kind of be in this trade, let it go outside in either direction and just kind of let it ride out for, that 50 cents. Now, what I was saying with the break evens, right? So if we look at the break even on this particular strategy, there's a couple of things to look at. What did we say? For the break evens, we have 2 of them, and you can see here we have 2 break evens. We take our out of the money put, which is the 46, and we are going to subtract that net premium. So from 46, subtract 46. Wait a second. The out of the money put, which is the we're going to have to add the premium in there for our break even. Sorry, people are blowing me up on this. And in your previous example, you rejected it, but you were looking at the at the money options. Can you explain that a little bit further there? I'll look at CLX in a second here. Did you not sell enough 92.5 strike? I may not have. That could have been part of it, but I think I did. We can go back. I'll show you guys another example as well of that bad example. So basically, if we're taking the puts that are the ones that are in the money, which are these 50 puts, right? Those 50 puts are in the money. So the 50 puts are in the money, and we need to subtract this debit paid. So you take the 50 minus the 47, and our break even is going to be right there at 49.53. To the downside, we take the out of the money put, which is the 46 puts, and add the premium back in, which puts us at $46.47. That's our break evens. And that is for expiration, right? So the only way to get that is at expiration to have all that stuff come together. But it gives you a ballpark figure. If the market really starts moving, it might feel like you met a break even well before that, but that's for expiration. And then, your max profit, like we said, our max loss is the $47. Our max profit is the width of the strikes from the base to the other side minus the 47 cents. That puts us at $1.50 in a sense or $1.53 for the max profit. Would you buy a put and flatten the downside curve? I wouldn't. You're just, if you buy a put, then you're increasing really your risk in a sense. And this is a defined risk strategy, so I'm not going to probably play around with that too much. So if the max profit is on the top of the risk profile, will happen if the IV drops or goes up? Great question. So we can even look at that on this, as a matter of fact. If I can remember how to do it. I think it is right here. Where is that? Is it in here? There it is. Volatility adjustment. What happens if volatility increases? We start seeing this start to go up. Really, it's not going to affect us too much because we've kind of offset most of that risk. And if it starts going down, it's not going to increase or decrease our max profit or our max loss, right? This is all going to say the same because it is defined risk. But what will happen is, watch the purple line. If we get that volatility decreasing, you see that purple line is kind of creeping up. And what that means really is that you are able to achieve above, you're able to achieve it faster. Does that make sense? You're going to be able to get out of this strategy for what I talked about faster. Where did I get the 47 cents? Right here. Sold 2 of the 48 puts, bought 1 of the 50 puts, and bought 1 of the 46 puts, which is $2 wide in both directions, 47 cent debit. That's our max loss. That's all we can lose. Our max profit is if the underlying is trading right at $48.00 when the bell finally rings on that Friday. Highly unlikely, because it's always going to probably be a penny here or there, right? Have you ever seen anything settle right on the dime or right on the whole dollar? Okay, does that make sense for everybody there? How that all works out? All right, I'll give you an example of one that is a bad example. So because that one that we were looking at kind of looked a little funky. Let's look at UPS, because this is the one I vetted for a bad example. So we can look at this. It's trading 105 right here. So the and this was the skew to this side, right? So we probably should be doing the call butterfly if we really wanted to do this. But I wanted to show you an example of if we sold. Did I get the second one in there before it jumped on me? If I sold two of the 105s and then I bought the let's say the 110, let's just go $5 wide. So bought the 110s and the 100s. Okay, so sold two of those. Maybe I did mess that up earlier because I thought that this was a little worse than 1-to-1 on that one. But actually, this would be almost a risk 1 to make 4 in a sense. So that's a pretty good example there on the debit there. I don't know, I must have punched that in wrong. But there are situations, you guys, where you will be paying, $4 for a $5 wide butterfly, and that just doesn't make sense. Just get away from it. Run away. Do you look at open interest for the wings of the shorts? I don't really, because, well, I will look at volume and open interest, especially on some of those ones where I was like, okay, these prices are a little bit wider. Maybe it was Microsoft, I think was our example. We'll see it with Microsoft. There is a lot of volume and open interest. Like, it didn't fit that rule of thumb. Remember, it's $100 stocks should be $10 or 10 cents wide in here. Well, if we look at the volume and open interest, there's probably a lot of volume and open interest going on today. And that's an indication that these prices are a little bit wanky. And I'm sure people just pulled everything. But you can see a lot of volume and open interest. These are 10 cents wide normally during open market operations. So if it is a little bit wide, I will go and double check this. You will see stuff like Aon where, it's probably going to be pretty wide, 40 cents wide here. Look at the volume and open interest here on those monthlies. Like non-existent. So stay away from this because you are going to have to give up a lot of edge. There might be one guy trading this, making those markets, and you're going to have to come to him. So we want the IV to go down and the purple line to move up. Yes, and that's just a sense as what that purple line really indicates has to do with, I think it's the underlying, but when that volatility goes down and that line moves up for this particular strategy, that just shows you that the premium's increasing in value in a sense. Okay. Ryan saying my quantity on that other one was wrong. It might very well have been. And it might have very well been wrong when I did this UPS one too. But what I was saying with this, you can see, we were talking about on a Friday, nobody's leaving orders in there, but you can see 40 cents wide here, 35 cents wide there. But the reason why those are wide is because there is nobody in there really trading it. There's not a lot of participation. So stay away from something like that. Okay, so the best case scenario, risk 1 to make 5. Good. I really like the risk 1 to make 3. And the worst I will do is risk 1 to make 1. And if I risk 1 to make 1, I'm going to be willing to get out quickly. So John's asking a great question. When volatility goes down, shouldn't the premiums be decreasing? They absolutely will. I'm not going to lie. They are going to decrease. But remember, what was our one we were just looking at? Was it, what was I just looking at? Anybody remember? All right, I'll just look at Starbucks because I can't remember what my last example was. So Starbucks, a lot of volume and open interest, fits the rule, $100, under $100 stock, inside 10 cents, we're good. All right. Is the skew to the downside or the upside? It looks like the skew to me is to the upside, just at first blush. From the 55 to the, it's 47, so this is to the half. So if we go $2.50 to the upside, $2.50 to the downside, actually there's pretty reasonable skew. It's pretty close because we are closer to this strike. So it's going to be pretty neutral. So let's go with it being neutral for Starbucks. And we can look at the monies, which are probably the 47.5. Those are the closest two, right? So sell two of these and buy one of these $2.50 wide and buy that one. So 63 cents, that's inside my rule. Less than 80 cents for a $2.50 wide one. So that's a good strategy as well. That's a pretty good one. We can look at the risk reward on this on the Analyze tab. Why was I got off the subject of why I was looking at the other options. So risking 63 cents to make, 100 and, well, it's $2.50 wide. I'll figure it out that way, $190. Okay. So that's on Starbucks. I'm bearish on Starbucks, or at least don't think it's going to go up. So that's why you saw that other option in there. But, it doesn't mean that you couldn't be like, it's not going to go up and I think it's going to stay right here. Oh, one of the things I was going to tell you guys about when I was looking at these, what I like to look at is when the market's made a big move and kind of comes down to the point of control or gets in between a Fibonacci level, is where I really like to do this. Because what the point of control is, that's where the most time and volume has been spent. That's where the most money is exchanged hand. Anytime it gets there, everybody becomes very complacent. They're very happy. If you're not making money or losing money, you're usually very content because the stress increases, right? You're making a lot of money on a trade. All you can think about is, should I cover it? And when you're losing a lot of money, all you're thinking about is, should I cover it? When it's right there, you're like, hey, I'm fine. And that's why the market usually settles down around those points of control. So Starbucks looks like it, is a little bit higher than that, but you could even throw up your Fibonacci's and do something like, if the Fibonacci's would work. It's not gonna, my computer must be running slow, but lands inside the Fibonacci levels, you think is going to ping back and forth. That would be a good situation. We can look at a couple of other ones. I think Verizon was one of those that looked like it was right here at the point of control, right? So look, the 200-day moving average is lining up with the point of control. This is where all the time and volume has been spent. So it's made a big move. It looks like it's settling down. Does that mean it's going to sit there for very long? Not necessarily, but you can see a lot of times when markets make those big moves, they do have a tendency to settle down for a little bit. And that's what I'm looking for. Boom, makes a big move, settles down for a little bit. Boom, settles down for a little bit. So that's what I look for in this type of situation. And somebody was saying, in this kind of market, we got high volatility. The market's going all over the place. Well, yeah, I'm a bit of a contrarian. Once we see all that and volatility gets jammed up, I have a tendency to be, fears overstated. People are like acting irrational. That's the time to, take advantage of the volatility. And if you thought it was going to settle down like ping right here, I think that a lot of these things are lining up. Like if my Fibonacci would work, and it's not going to. I don't know why my Fibonacci does not want to work while I'm doing this. Let me try and pick a different one and see if it works. All right, so let's go with this fib, see if it, there we go. So I'm going to do this quick and dirty. I'm not going to, maybe my battery, my clicker is going bad. So look at this, great situation. Got right in between, the point of control is right in between these two fib levels. We've got a lot of things going for it. This is the one that I was really looking for to work out, because I think this is a really good one. So those are those 48s. And what did I say? The 50s. So I was doing 48 to 50. So I have another Fibonacci up there, 48 to, what was it, 46 to the downside. So I've got a lot of room with this. I mean, when you look at those wings, anything inside there for the most part is going to be a pretty good day. That's a lot of wiggle room. And that's what you're going to get when you have a lot of implied volatility. All right. You're going to get yourself a lot of wiggle room, and I think that this is going to want to ping around inside of here for a little while. That's one of those reasons. So those are some of those things that I look for when I want to implement this strategy. And one thing that I really like to look for a neutral market assumption is when the market's made a move right back to the point of control, or where the most time and volume's been spent, because that's where everybody's happy and very complacent. Does that make sense? So if IV goes down, you said, I think I've already read that one, did I? Yeah, if IV goes down, that purple line will go up, which means that your premiums, in a sense, are going up. Okay? Because those ones that are at the money, you know, these are the ones that we want to decay, and that's where all our premium is, right? These are the ones that we sold. You know, that's a lot of premium, and right now that's all extrinsic value. All of that is extrinsic value, which means can decay to zero. We look at these 50s have about 77 cents that can decay. So those are the ones we bought. The ones we bought can decay by 77 cents because 50 to 48 is $2, so 77 cents can decay, or going $2 down, this is all extrinsic value, so I can lose $1.50, but I'm going to be making that $1.50, right? If it all decays out, because the $1.50, I'm collecting $3, lose $1.50, I get the $1.50. Verizon skew is skewed to the what did I say? I think it was skewed to the downside. 2 down is 83 cents, 2 up is 70 cents. So there is skew to the downside. Bearish skew. And there is, like we said, normally skewed to the downside, but we've seen a couple of examples already today where there is skew to the upside. Microsoft being one, Amgen skewed to the upside. And I think maybe even UPS was skewed to the upside. So you will see that happen. Fibonacci levels are such a farce. You can give me 10 different levels for a stock, and of course, at some point, the price will be near one of those levels. Listen, I'm not a huge Fibonacci guy. I do look at Fibonacci because I look at it like Fibonacci. If everybody is doing it, then there's going to be some validity in there, right? It's going to come to those points and act as support and resistance, because that's what everybody's looking for. So it's kind of like, does it have to do with a shell having these numbers, or a leaf, or these all kinds of levers and pulleys in the universe? But if everybody's looking at it, a lot of times they do have a tendency to come into line, is all I can say about that. A lot of people do like to look at them. One thing I do like about Verizon, though, is Verizon lines up very nicely with my market profile. So that does have a tendency to, give a little bit more validity to it. And this 200-day moving average running right along with this, where the most volume's been, where the most money's changed hands, it's going to get, I have a feeling it's going to get pretty complacent. I know, I get, you look at them too, but it's still nonsense. I agree. I'm looking forward to reviewing this. Yeah, at a slower pace. Great, Bandu. I think I said that right. Great observation. He said he's going to watch this again because there's a lot to take in, and I'm not going to disagree with that. One thing I always say at the beginning, and I may have forgotten this, is always watch this again. We're giving you guys that recording. Watch it again and again, as a matter of fact. but watch it relatively soon after watching this one, because all of it's going to come together the time you watch it over again. Right now, you're having questions. I'm going over a lot of new material. Especially in the beginning, could have been confusing. I tried to, emphasize what we're looking at and then come back into the platform and review that a little bit to help you guys remember. But if you guys wait a month down the road, watch this again, it's going to be like learning it over again. So try and do this relatively soon after receiving the webinar. But this to me seems like the best case scenario for the ones that we've looked at. But one thing, there are other option strategies out there with higher probability, but with this one, I would think, like an iron condor, I'd probably be market neutral on this anyway, but I'm going to be able to collect a lot of premium, more so than I would with an iron condor if we stay right here. So that's what I'm looking for. All right, guys. I want to thank you guys all for joining us. This is the deal we're doing for today. It is in the chat window, so go ahead and click on that. We've been communicating back and forth in the questions box over there in the chat window on that main screen there. You'll be able to see a chat window. I put the link for this in there. This is basically Volatility Crush, and right now we are experiencing high volatility. So it's really important to understand volatility, how it affects the premiums and everything else. This is how I trade. This is my favorite way to trade, is with volatility, selling premiums. It's, if you are a very newer trader, you should really understand volatility. I believe volatility is probably more important than even delta when you're trying to decide strategies and things of that nature. You really need to understand the concept of volatility and how it affects premiums. And, like even with that skew, what is the market predicting this underlying is going to do? What are they worried about? Microsoft, they're worried about the upside. Verizon, they're worried about the downside. So those are good market insights that you can get from the options premiums that I talk about in all of these different webinars. And this is a great deal for Volatility Crush. Like literally, if you guys have been watching any of my daily market commentaries, you know that this is my bread and butter, selling volatility. That is where I make my money. That is the bread and butter of my trading, and it always has been. So really important to understand these concepts. So if you've learned anything at all whatsoever, if you enjoyed my webinar today on long put butterfly, yeah, I know you guys can go out there and look online and find long put butterfly. Yeah, they're going to tell you, yep, you sell 2 at the monies, or you sell 2 strikes, buy 1, further away, equal distance apart, whatever. They aren't going to talk about volatility. They aren't going to talk about how much premium you should expect to pay and where you should get out of this strategy. All of those things are probably the most important things you can learn when you're doing a strategy, and that you're not going to find that stuff online. And that's exactly how I teach. So if you learned anything at all about a strategy maybe you even know about, you are going to really benefit from this. And we're discounting it quite significantly today for you guys that have watched it. So the best way to become a better trader is to constantly learn, you guys, which you guys have obviously done, and I applaud you for that. I mean, I try and learn every day too, I'm always studying and reading books on markets and stuff like that, and how to trade and what their thoughts are on it. I don't always agree with them, but it is what it is. It's good to know other opinions, even if they're not the same opinions as yours, to know the other side. So basically, at the end of the day, learning is key to your success, and how to create option strategies is easy, but knowing how to trade those strategies in the right environment, picking the right strikes, is essential to increasing your probabilities of success, and that's how I teach it. So even if you're using technical analysis or building some kind of chart, all of those things, like we said, even with Fibonacci, yeah, they do come to fruition. We all kind of look at them, but does it always mean anything? I don't know. I would say that we probably don't all know what market direction is going to happen, but That's why I want to play the probabilities in my favor, because I don't necessarily know. And if you're going out and buying a stock, that's a 50-50 chance that you're going to be right. That's the probability. So I'd rather play with the probabilities of better than 50-50, and that's what I try and teach in these. So is how to play the probabilities. And when the probabilities have gone against us, how to stay mechanical and increase our probabilities even further. All right. This strategy, I'm probably going to let it ride out if it goes against me, because I'm paying so little for that strategy and the reward is so significant. And I know the probabilities are against me, but that doesn't mean that it can't go out there, test my wings and come back in, and I'll be happy, because that will happen a lot with this strategy. It'll go out there outside your wings and you're like, I just wasted money. And then next thing you know, it'll come back in line, and you've had that theta decay and everything else in your favor. It works out nice. So we're offering this trial for you guys today. So what do you say? Like I said, it's over there in the chat window. Go ahead and click on that. You guys could easily pay for this strategy from what you learned, or pay for this course from what you learned in all of these classes. I mean, you can see there, this is a pretty heavy duty class, or heavy, a lot of classes in this particular course, and all of them very important. So by the end of it, you should be very well versed in volatility for sure. So if you learned anything at all from me today, I appreciate it. Let me know. Trevor says he likes mine. Thank you. I appreciate it. Thank you, Banu. Thank you, Farshid. I appreciate it. All right, that's it, you guys. One last thing, though, real quick. After you clicked on that, I just want to say thank you, guys. This is really all I'm doing. Is in later webinars, we'll be drilling down on different option components, how I trade them, when and where I find them appropriate. Here's the link. This link is a dead link. The best link is to get that chat window. But if you're watching this, say, Saturday morning, pause it, write this down. We're going to give you guys a few days to get this recording and have this offer still good for you. But if you have any questions, reach out to us, 310-598-6677, or email us at trading@protraderstrategies.com. Also, if you go and to the website, there's a little quick video down here at the bottom you can watch about why I think volatility is so important. So that's also the link there that you can kind of pause, type it into your URL, but this is the actual website, and there's a little video there to go into it a little bit more. And for Trevor and JQ, if you can't take that, take it easy. Take care, you guys. Thank you, Farshid. Appreciate it, Chalk. Thank you, guys. Thanks, everybody. Have a great weekend.